If you could get a job with a salary of $50,000 in 2019 today, that same job pays $55,000. That's not a raise, that's a pay cut. And it's not an accident. Corporate profits soared to record highs while your real wages fell. That money didn't go to you, it went to shareholders and executives. Now you're 10% poorer and they're 40% richer. Let me show you the exact mechanism of the theft. It's not laziness. It's not inflation alone. This is a hidden wage suppression scheme that took 20% of your earning power and transferred it to capital. And most people don't see it because it's been deliberately obscured with corporate jargon. Maximizing shareholder value, operational efficiency, right-sizing. These are just sophisticated words for theft. Let me show you the exact playbook, who executed it, who profited, and why your paycheck is now permanently weaker. Here's what happened starting in 2020. The pandemic created chaos. Unemployment spiked. Everyone was terrified. And corporate America saw an opportunity. They had a choice. They could use the crisis to invest in their workforce, share the burden, and build long-term loyalty. Or they could do what they've been trained to do since the 1980s. Protect margins, boost the stock price, and freeze wages. They chose the freeze. Across the board, hiring stalled. They cited uncertainty. But behind the scenes, a new strategy was being activated. It was called efficiency through technology. Let me explain what that actually means. Companies realized they could run with fewer people. They loaded more work onto remaining employees. One person now does the job of 1.5. They installed tracking software on your laptop. They measure your productivity with keyloggers and screen capture algorithms. They use AI to monitor customer service calls for optimized tone. This isn't about efficiency, it's about control. They created an environment of perpetual performance review. You're constantly being measured, ranked, and threatened with automation. Before the pandemic, the average span of control was 1 manager for every 10 employees. By 2023, it was 1 manager for every 15. They didn't hire more managers, they just gave you more work, and they used the fear of recession to make you accept it. You were told to be grateful you had a job. Meanwhile, CEO pay skyrocketed. In 2020, the average S&P 500 CEO made 274 times what their median worker made. By 2023, that ratio was 350 to 1. That's not a reward for performance. That's extraction. Now here's what you need to understand. That profit didn't come from magic. It came from you. Your stagnant wage is their rising dividend. Your increased productivity is their stock buyback. Let me give you a specific example. You work in marketing. In 2019, your team had 5 people. Budget was $1 million. Now, you produced 100 campaigns a year. Then the restructuring happened. 2 people were laid off. Streamlining. The budget was cut to $800,000, but the goal remained 100 campaigns. You and your 2 remaining teammates are now working 50-hour weeks. You're using free AI tools to draft copy faster. You're managing 3 social media accounts instead of 1. You hit the target, 100 campaigns. The company saved $200,000 in salary and $200,000 in budget. That $400,000 went straight to the quarterly profit statement. The stock went up 5%. The CEO got a $2 million bonus for improving margins. You got a thank you email and a 3% raise. But your output per person increased 66%. You were paid 3% more to do 66% more work. Your effective wage per unit of work plummeted. That's the theft. Your effort didn't disappear, it just became worth less. Increased productivity is the mechanism, and it's not evenly distributed. It hits salaried employees the hardest. If you're hourly, overtime laws protect you somewhat. But if you're on salary, your time is an open-ended resource to be extracted. The profit gap didn't widen by accident. It widened by design. And the C-suite executed the design. Now let's talk about where that profit actually went. Because understanding the flow of money shows you exactly who benefited. When a company boosts its profit margin by suppressing wage growth, that excess cash doesn't get reinvested in R&D. It goes to shareholders, stock buybacks, dividends. In 2022 and 2023, S&P 500, companies spent over 1.5 trillion on buybacks, buying their own stock to artificially inflate the price. And who owns the vast majority of stocks? The wealthy. The top 10% of Americans own 89% of all stocks. So the money extracted from your stagnant wage is directly transferred to the portfolios of the already rich. This is how the mechanism works. If you're a fund manager with $1 billion in assets, you demand quarterly profit growth. You vote against executive pay packages that aren't tied to share price. You pressure CEOs to cut bloated payrolls. The CEO, whose bonus is 90% stock-based, complies. They freeze hiring, increase workloads, and report higher profits. The stock price rises. You, the fund manager, get a bonus. The CEO gets a bonus. The shareholder sees their portfolio grow. And you, the worker, get a burnout diagnosis and a 3% raise that doesn't cover inflation. You're not a participant in the prosperity. You're the fuel. Now contrast that with the post-war era. From 1945 to 1970, productivity and wages rose in lockstep. When the company did well, the worker did well. That social contract has been shredded. Since 1979, productivity has grown over 3x faster than hourly compensation. The gap between what you produce and what you're paid is the largest it has ever been. That gap is the theft, and it's been normalized as good business. Let's look at the numbers. From 2020 to 2024, corporate profits after tax increased by 35%. Real average hourly earnings for workers decreased by 2.5%. The economic pie got bigger, but your slice got smaller. The top 1% captured nearly twice as much of the post-pandemic income growth as the entire bottom 50%. This wasn't because they worked harder. It's because they owned the assets that benefited from your suppressed wages. If you owned stocks in 2020, you got rich from the profit surge. If you worked for a living, you financed that surge with your unpaid labor. This is the theft. Corporate America takes your increased output, pays you a fraction of its value, and transfers the difference to asset owners. It's a transfer mechanism from labor to capital. And it's legal. Not just legal, it's celebrated on earnings calls. CEOs boast about disciplined cost management, which is code for we're not raising wages, they're rewarded for it. Let's talk about what record low unemployment actually means, because the headline and the reality are very different. The government says unemployment is under 4%, a strong job market. But that number hides the truth. It doesn't count the millions who've given up looking. It doesn't count the underemployed. It doesn't count the college grad driving for Uber. The labor force participation rate for prime-age workers still hasn't fully recovered to pre-2008 levels. There are jobs, but they're bad jobs. Precarious, contract-based, low-benefit gigs. The rise of the fissured workplace. Companies outsource to subcontractors to avoid paying benefits. They use temp agencies as a permanent underclass of labor. They classify workers as independent contractors to shift risk from the corporation to the individual. You bear the volatility. They keep the profit. So when you hear record job growth, ask, growth of what? Growth of jobs that can support a family, or growth of poverty wage? Gig work? Your lived experience of financial stress is correct, even when the headlines say the economy is booming. Here's why this matters. If corporate profits are at record highs, but your standard of living is falling, the system is not broken. It's working exactly as designed for the people who designed it. And when you complain about being overworked and underpaid, managers say we're a family, or we offer great exposure. But exposure doesn't pay the rent. This is the hidden tax. Income tax is visible. You see it on your paycheck. Sales tax is visible. You see it on receipts. But wage suppression is invisible until you try to get a raise and realize your company has a salary band that caps your potential. Corporate America caused this stagnation by prioritizing shareholders over workers, and they knew it would suppress wages. This wasn't an accident or an unforeseen consequence. They understood that pitting workers against each other in a competitive market would devalue labor. They did it anyway because their priority was protecting the stock price and their own bonuses, not your purchasing power. Let me show you how they justified it at the time. In 2021, as inflation hit, CEOs went on earnings calls and said, "We must manage our workforce costs to combat inflationary pressures." The rationale was that holding down wages was necessary to control inflation. But here's the question nobody asked. Why did executive pay and shareholder returns continue to soar at record rates? If it was about shared sacrifice, why was the sacrifice only shared by employees? The answer is obvious. It was never about sacrifice. It was about opportunity. They used the cover of inflation to enact a permanent downward shift in labor's share of income. If that $1.5 trillion in buybacks had been divided among the 130 million workers in America, that's over $11,000 per person. For a family of four, that's $44,000. Imagine if instead of giving that money to shareholders, companies had given every employee an $11,000 raise. The economy would have boomed from the bottom up. But that's not how the system works. The system is designed to funnel money upward. The board serves the shareholders, not the workers. You're a cost to be minimized, not an asset to be invested in. This is called the agency problem. The people running companies, the agents, are supposed to work for the owners, the principals. But their incentives are tied to short-term stock performance, not long-term company health. So they cut the easiest cost to cut, you. They underinvest in your training, your tools, your wage. They report a great quarter. They cash their bonus. And by the time the long-term damage of a demoralized, burned-out workforce shows up, they've already retired with their millions. The agency problem explains why corporate strategy always seems to screw the employee. It's not a bug. It's a feature of how corporate governance is structured. Now let's talk about who runs these companies and why they designed the system this way. The C-suite is not filled with visionaries building things for the long haul. They're filled with financial engineers. Most Fortune 500 CEOs come from finance or consulting, not operations. They're experts in spreadsheets, not products. Their goal is to create shareholder value, a term invented in the 1970s that has since become a license to loot the company. They have a revolving door with the private equity firms and hedge funds that pressure them. This creates a structural conflict of interest. If you're a CEO and you know your tenure is 3 to 5 years and your legacy is the stock price, are you going to approve a costly, long-term employee development program? Or are you going to approve a stock buyback that will immediately boost the share price? The latter is far more common. Corporate America has been captured by the financial class, and that's why in every economic cycle, the first move is to protect margins and the stock price, not the workforce. In 2008, they did mass layoffs. In 2020, they did it again. Every single time the pattern is the same. Uncertainty hits, profits are threatened, they cut jobs and freeze wages. The stock price stabilizes or rises. Ordinary workers get some scraps, a small bonus, maybe a pizza party, but the bulk of the savings goes to the bottom line and out to shareholders. And over time, the labor share of income shrinks. Since the 1970s, labor's share of national income has fallen from over 65% to under 58%. That 7% shift represents trillions of dollars that used to go to paychecks and now goes to profits. That's not a coincidence. The corporate war on labor is the primary driver of wage stagnation in the modern era. Now let's talk about what this means for you specifically. If you're under 40 right now, you've been financially neutered by a system that sees you as a line item, not a human. Let's walk through a scenario. You graduated in 2018. You got a job at $50,000. By 2020, you were up to $55,000. You were a top performer. Then the efficiency drive started. Your team shrank. Your workload doubled. By 2024, you're making $65,000, an 18% nominal increase over 4 years. But inflation was 20% over that period. So in real terms, you took a 2% pay cut. Meanwhile, your responsibilities tripled. You're now managing vendors, projects, and interns that used to be someone else's job. You ask for a promotion. HR says the salary band for your title maxes out at $70,000. You're trapped. The only way to get a real raise is to leave, so you jump to another company for a 15% bump. But the cycle repeats. You've become a job hopper not by choice but by necessity. Your loyalty is punished. Your company's solution is not to raise salaries, but to hire more junior people they can pay less. You're now overqualified for your own job. You've been lapped. You're on a hamster wheel, and this isn't because you aren't valuable. It's because corporate America systematically undervalues existing employees to fund shareholder returns. You've been systematically impoverished by corporate policy. Now, let's contrast that with someone who entered the workforce in 1980. They got a job. They stayed. They got regular, meaningful raises that outpaced inflation. They got a pension. They retired comfortably. That world is gone. It was dismantled. The new world is designed for you to never get ahead, to always be insecure, to always be one missed paycheck away from crisis. This is the theft. It's a transfer of wealth from people who work for a living to people who own for a living. And it's accelerating. Since 2020, real wages for the bottom 80% have fallen. CEO pay is up 40%. If you earn a paycheck, you're treading water. If you own the company, you're getting rich. The system is designed to reward ownership and punish labor, and corporate America's wage suppression is the engine driving this divergence. The inflation of 2021-2023 was just the cover story. The real story is the greatest wealth transfer in modern history, from your paycheck to their portfolio. And unless you understand how the theft happened, you can't protect yourself from the next round because it's coming. The next recession, the next restructuring, the next efficiency drive. And if you're not prepared, you'll get robbed again.